Wall Street bets and the meme stock craze of 2020 brought the stock market front and center for a lot of people. But for every story of someone becoming rich overnight in the stock market, there are countless others where people have lost their shirt trying to trade the stock market. I'm Terrell Higgins, a real estate and personal finance nerd, and I actively traded the market for almost 3 years. Most folks are trying to sell you a dream of becoming rich overnight in the stock market. I'm going to give you the actual insights of things you need to avoid and things you should be looking out for if you try and trade the market. And I'm also going to share with you what I'm currently doing to trade the markets. And no, it does not involve me being glued to a computer analyzing stocks day in and day out. Let's get into it. So the first thing I like to do is to clear up a misconception about the market. People always say that you cannot beat the market, but that is a complete myth. There are a bunch of things that actually outperform the S&P 500 stock market. So if you just bought Bitcoin, that would outperform the stock market. Fine art actually has outperformed the stock market for the last 30 years. And some real estates even outperform the stock market. So the idea that you cannot beat the stock market is a myth. And you actually have some distinct advantages as a small investor in the stock market. There are strategies available to you that a large institution cannot employ. So when a large institution buys into a company, they can influence the stock price of the company just by assuming those positions, where the little guy has no impact. You can buy into penny stocks, you can buy into large stocks, you can move completely unnoticed through the stock market and engage in any strategy that you want. But if you have billions of dollars, there is a lot more regulatory scrutiny about what actions you're taking in the stock market, and it is a lot more difficult to beat the market. So when they say you can't beat the market, what they really mean is you can't beat the market if you have billions of dollars or even hundreds of millions of dollars. That's when the game gets difficult and it becomes difficult to beat the market. So when I was actively trading the market, it was not uncommon to see swings of 20, 30, or even 40% in a single trading day. So you can absolutely beat the market. As a little guy, you can turn any idea you have into a trading strategy. So my favorite thing to trade when I was actively trading were ETFs, exchange traded funds. So these exchange traded funds just track an underlying index. And these indexes track pretty much everything. So there's an index out there that tracks pet care. There's an index out there that tracks what's trending on social media, an index that tracks consumer products that are bad for you. So any idea that you have, there's probably an ETF that tracks that thing. If you're looking for one that tracks the S&P 500 or the NASDAQ, there are ETFs out there for those things. And if you know that that thing is going to go down, you can actually just purchase an inverse ETF. So the inverse ETF will climb in value as that price of that underlying index goes down. So you can make money from something going up or going down by just buying an ETF or an inverse ETF. And then if the moves in that underlying index are small and you want to amplify the gains that you can make from that underlying index, you can actually buy leveraged ETFs. So they have 2x and 3x leveraged ETFs. So if the underlying security moves 1% and you have a 3x leveraged ETF, your ETF is going to move 3%. And they have these 3x leveraged ETFs for NVIDIA, the NASDAQ 100, and the S&P 500. They are out there for your consumption. And these products already exist for a wide variety of things. Just note that if you start trading these inverse and leveraged ETFs, you're going to start getting about 1 million warnings from your brokerage telling you that it's a terrible idea. And they're absolutely correct. It's a terrible idea. This volatility goes both ways. If something can go up 3x in a day, it can go down 3x in a day. And what happens with these highly leveraged ETFs is that they slowly start to decay away from the underlying index. So holding them over the long term is generally a terrible idea. They're specifically designed for short-term moves in the market. So just buying and holding and waiting, your money is slowly just going to decay away. Risk management is the name of the game. You want to live to fight another day. You have to control your position sizes, and you have to be willing to take profits when you are right. Bulls eat, bears eat, but pigs get slaughtered. If you're greedy in the stock market, you're going to lose every time. And the strategic use of stop losses and trailing stop losses has saved me on multiple occasions from blowing out my account when I was actively trading. Using the right order type is essential if you're actively trading the markets. And you kind of learn this lesson very early on, but you should never set market orders. So if you're buying and holding for the long term, a market order is perfectly fine. But if you're planning to hop in and out of a position within a given day or a week or a month, you want more precise control of what price your actual position is established at. And if you just set a market order, you don't have that precise control. So these brokerages, they make money by selling their trade volume to market makers. So Robinhood was the first brokerage to completely eliminate commissions on their trades, and it's pretty much industry standard now. But the reason they were able to do this is because these market makers make money between the bid and the ask spread on market orders. So if the stock is trading at $10 and then they sell it to you for $10.01, that spread makes them money. And it doesn't seem like a lot, but when it's millions or hundreds of millions of trades in a given day, that money stacks up very quickly. And that 1 cent may be 5, 6, 7, 10 cents difference in the stock price, which can be your entire profit in a given trade if you're trying to scalp a trade or hop in and out in a single day. Which brings me to a misconception about day trading. Most people can't and don't day trade. So there's actually pattern day trader rules around trading in and out of a position in a given day. So if you make 4 or more day trades in a 5-day period, you're labeled a pattern day trader. And that brokerage can actually halt your account for up to 90 days. And the only way to get around this is to have over $25,000 worth of money in your account. If you're above $25,000, you can get around these pattern day trader rules. But most people, when they start trading, don't have that amount of capital to actually allow them to day trade the market. The other thing traders don't think about is accounting. So the accounting is essentially voodoo witchcraft. I'm gonna do my best to explain it, but the accounting for stock investing gets very complicated. So the first thing is wash sale accounting. So if you are selling a stock for a loss, you can claim that loss on your taxes. But if you assume a position of similar size in that same company you had a loss in within 30 days, then you can no longer count that loss on your taxes. So there are people who've had losses off of certain stocks and it wiped out their gains on those stocks, but because of wash sale accounting, they weren't able to count those losses and they owed large tax bills for money that they didn't even have. And the other thing that makes accounting really strange for stocks is the cost basis of your stock. So if you buy into a stock, that's your initial cost basis. But if you buy more stock later on, then it gets funky because now you have to decide what cost basis method you're using to account for your stock. So the one that makes the most sense is the average method. So whatever the average cost of the stock combined together is, that's the cost basis. But that's not the one that's most favorable for taxes. There's a first in, first out method. There's a low cost, there's a high cost. There's a tax lot optimizer method where they look at how you've been trading to figure out the best cost basis method for your taxes.
Shrimp kebabs, shrimp creole, shrimp gumbo, pan fried, deep fried, stir fried. There's pineapple shrimp.
So it gets very complicated very quickly. And if you are actually trading the markets actively, you want a good accountant because that can be the difference between you paying a large tax bill and paying no taxes at all. Imagine if everyone was investing in a company that's been unprofitable for 17 years and the stock price keeps continuing to climb. That company was Tesla. It had a ton of short interest going against it, and there were 17 years straight of it being unprofitable. So the market can be illogical for days, weeks, or even years, and trying to predict people's behavior over short periods of time is nearly impossible.
At points today, the Dow was down more than 1,000 points, driven by uncertainty about the health of the U.S. economy. And let's take a look at where all three major U.S. indexes closed today, all of them in the red. You can see the Dow down almost 3 points, the NASDAQ down almost 3.5 points, and the S&P falling just short of losing 3% today.
You don't want to be trading based on fear and doubt and uncertainty. You need to come up with a trading strategy, backtest that strategy, and stick to that plan. If you are just going on your gut instincts and news articles and the latest headlines, you're already behind the 8 ball and you're not going to be making sound decisions. And a lot of brokerages are playing upon people's gamification of their stock profiles. Robinhood actually had a lawsuit brought against them by the Massachusetts Secretary of State for them using gamification practices on their platform and encouraging unhealthy trading behavior. And all those trades, they were making money from their market maker because people were hopping in and out of stocks when the best practice is just to buy and hold. So you want to avoid any emotion in your trading. Kenneth Fisher, the founder of Fisher Investments, said that time in the market is always better than timing the market. If you try to time the markets, you have to be right twice. You have to be right when you exit, and you have to be right when you re-enter. Or you have to be right when you buy, and you have to be right when you sell. But if you avoid all that timing, if you're looking at long enough time horizons, it doesn't matter if you get it exactly right. If you are predicting that the stock market is going to be worth more 20 years from now, that is a very safe bet. If you're predicting the S&P 500, the group of the largest 500 companies in the world, is going to be worth double or 3 times what it's worth now, 30 years from now, that's a very, very safe bet. And these are the type bets that you want to be making. You don't want to be speculating on short-term moves. And not everybody is playing by the same rules. So for a while, I was playing the earnings calls for companies. So for an earnings call, for the stock price to go up, a company has to be on revenue, earnings per share, and the CEO has to give good guidance. So you need that trifecta of things for the stock price to go up. And if any one of those three things is off, the stock price is going to go down. So I was doing my research into offshore drilling companies, and I found a company called O-Rig. And they were buying distressed assets, and their financials showed a very healthy profit margin. It showed a bunch of contracts going well into the future. And while a bunch of other offshore drilling companies were shutting down, they were actually accumulating more distressed assets. And looking at their books, I thought, this company looks like it's going to crush earnings. So I bought in, I'm listening to the earnings call, and then sure enough, they destroyed earnings. I made 100% gain.
Nice.
So I sold, I took my profits, and then the next quarter rolled around. I did all the same due diligence. I looked at their books again. I looked at the activity that they've been conducting across that quarter, and it was a lot of the same features. They looked like they were positioned to crush earnings again. So I'm listening after hours. They announced their earnings per share. They beat. They announced their revenue number. It's a beat. And then the CEO starts talking, and he says that these results are unsustainable with current market conditions, and they may have to pursue restructuring and potential bankruptcy. How could he possibly say this when the financials of the company were in such a healthy place? And I realized that the CEO was George Economou. So he is notorious for taking advantage of shareholders and extracting value from companies at the expense of shareholders. I had done all the research on the company itself, and I had done virtually none on the CEO. And that was a huge mistake. It made me realize that if I don't have the time to dedicate to learn every aspect of business, then I don't have any business investing in single stocks. I need to be buying large indexes and large bundles of stocks, either in ETFs, mutual funds, or index funds, if I'm not going to be able to dig into every single detail of a company. So George Economou and his board of directors actually had very large debt positions in the company. They owned the majority of the assets of the company. And when they filed for bankruptcy in 2017, they did a debt to equity conversion. So sometimes that debt to equity conversion is 1-to-1. So whatever debt, then you get a 1-for-1 exchange into stock, equity in the company. But sometimes it can be a 1-to-2. So one debt turns into 2 shares of stock in the company. And this is what they did. They converted their debt into a more favorable equity position in the company, and they wiped out almost all the common shares that the shareholders had. And they made a fortune. And in 2018, the company actually was sold to Transocean, a different company. And this George Economou, he has a history of using other companies as shell companies to hide assets and control assets, and he does all these practices that are detrimental to shareholders. So not everyone is playing fairly. They don't have your best interest in mind. And I actually did an entire video on why institutional investors have a substantial advantage over retail investors, and you guys can check that out. Thanks for tuning in, and I'll catch you next time.